Booming iron ore sales to China have given mining giant Rio Tinto a record start to the year. Earnings more than doubled to $6.3 billion and expansion is back on the agenda. Here's Phil Lasker.
The Rio Tinto, burdened by more than $40 billion in debt through its acquisition of Alcan less than 2 years ago, seems like a distant memory.
We benefited from cost reduction efforts implemented in 2009 and are driving our operations at close to capacity in a strong pricing environment.
Net profit for the half year to June was $6.4 billion, up 260%. Net earnings in the major iron ore business more than doubled, the aluminium unit turned a profit and copper improved. The resources windfall has helped Rio slash debt from $42 to $13 billion over the past 12 months and position itself for growth. There are plans to spend $14 billion over the next year and a half on investments in Australia, China and Mongolia. Analysts were expecting bumper profits and they weren't disappointed.
Their management of the balance sheet has been good and a big turnaround. They've raised a lot of capital, they've gone through some asset divestments, they're virtually debt-free and have an amazing expansionary capital expenditure program in front of them. The only thing that you could possibly say is they haven't been very generous with the shareholders.
Rio Tinto declared a dividend of 49 cents a share in line with previous guidance. Rio says its key markets improved and the company doesn't see its fortunes diminishing, with a global economic growth forecast of 4% and Chinese growth expected to be 9%.
There's nothing remotely bearish in this result, particularly in their predictions going forward, and they're putting their money where their mouth is with an enormous amount of capital investment.
A view of the world which seems untouched by the mining tax.